Hello everyone, welcome to another video. In this video, we will actually be looking at HKFRS 15, and I will be discussing about step 2 of revenue recognition, which is about identifying the performance obligation. Before this, I have already created a brief video about revenue recognition, and there are, there are actually 5 steps. And I have also made a video on step 1. So if you're interested in watching that, of course, you can actually first watch those 2 videos, and then it will come to step 2. So let's get started with the step 2. So step 2 of HKFRS 15 is about identifying performance obligations. Right. So there are about more than 20 paragraphs in the standard, right? So from paragraph 22 until 45 or 44, it only talks about performance obligations and how to identify. So by that, it tells you the nature of, it tells you how complex this is. That's the nature of it, right? So let's look at paragraph 22. This video will not go over all the paragraphs, only the important ones probably, but let's see how that goes. So paragraph 22, at contract inception. So it's at the time when the contract is being signed, right? At the time of inception, an entity shall assess the goods or services promised in a contract with the customer and shall identify as a performance obligation. So performance obligation in general is nothing but what is being promised in the contract that is going to be offered to the customer. Either it's some sort of a good or a service, right? So that is the performance obligation. So that's what they say here as well. Each promise to transfer to the customer either a good or service or a series of distinct goods or services, right? So it's either one good or service or a bundle of goods or services that are distinct, or it's either a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer, right? So for example, your Netflix subscription would actually fall under 22B, right? So Netflix is giving you subscription every month in the same manner, same date, same time, right? So they renew it probably at the same date on the same time, right? So each month would be like that. And because there are 12 months, it will become a series of distinct goods or services rather than a simple good or service, right? So they also define what is a series of goods of. So in paragraph 23, they also define a series of goods or a series of distinct goods or services has the same pattern of transfer to the customer if both of the following criteria are met, right? So both of these criteria should be met. Each distinct good or service in the series that the entity promises to transfer to the customer would meet the criteria in paragraph 35, right? Of course, we will take a look at what paragraph 35 says. To be a performance obligation satisfied over time, right? So it has to be satisfied over time, and in accordance with paragraph 39 and 40, the same method would be used to measure the entity's progress towards complete satisfaction of the performance obligation to transfer each distinct good or service in the series to the customer, right? So Netflix subscription actually fits in very well in this example, because let's say you buy a subscription of a year, 12 months, right? So you're not going to get 12-month subscription right away. They are giving you the subscription each and every month, if that's the case, right? So that would be a series of distinct goods or services which will follow the same pattern and same pattern of transfer to the customer. All right. So that's basically what paragraph 22 and 23 talks about. It has to be a performance obligation is nothing but a distinct good or service or a series of distinct good or services, right? Let's look at paragraph 23 or paragraph 24 actually, sorry. So paragraph 24 says promises in contracts with customers. A contract with a customer generally explicitly states the goods or services that an entity promises to transfer to a customer, right? So either it will be, most of the times the performance obligation or the expectation would be explicitly stated in the contract. We don't really want any ambiguities between the client and the customer, right? Or the service provider, because that's just will create more problems in the future. However, the performance obligation identified in a contract with a customer may not be limited to the goods and services that are explicitly stated in the contract. So a performance obligation not necessarily has to be implicit, but those could be implicit services too, right? So for example, if you go to a restaurant, one of the services that you might be expecting is like good behavior of the servers there, right? That is also a performance obligation from the restaurant point of view, right? So because restaurant have to deliver a nice good behavior as well at the same time. So that would be an implicit, is the business practice. Even though a key performance obligation there would be the food that you're going to eat at the restaurant, right? So that food will be the main key performance obligation, which would be very explicit, because the contract could be verbal contract as well. If you want to watch a video on step 1, which is actually about contract, so you should go and see what actually contract is, and how contract can be made, right? So back to the restaurant example, food would be the key performance obligation, but of course, implicit performance obligation from the restaurant point of view to the customer would be nice behavior from the servers, which would be serving your food, or the staff at the restaurant, right? Manager or any other staff. This is so let's continue with paragraph 24. It says, this is because the contract with the customer may also include promises that are implied by an entity's customary business practices. Exactly what I said earlier, right? So in restaurant, it is a customary business practice that you have to treat your guests nicely. It doesn't have to be business practice. It could be even published policies or specific statement if at the time of entering into the contract, those promises create a valid expectation, right? So that is another keyword there. There is a valid expectation. So if you're going to a restaurant, there's an expectation that the staff is going to treat you nicely. Otherwise, why are you going to a restaurant? You can just cook at home and eat that food. That the entity will transfer, right? So that's basically paragraph 24. Let's look at paragraph 25. So paragraph 25 says the performance obligation do not include activities that an entity must undertake to fulfill a contract unless those activities transfer a good or service to the customer, right? So exactly what I said. It is an implied service in restaurant. A nice behavior is an implied service, and that is not part of the performance obligation. A restaurant cannot recognize revenue merely providing a good service to the customer, right? That providing a good service to the customer is part of the whole deal there. All right, so that's why you will see that that will not constitute as a performance obligation. So they have given an example here as well. For example, a services provider may need to perform various admin tasks to set up a contract, right? So they are taking a contract from a contract point of view. The performance of those tasks does not transfer a service to the customer as the tasks are performed, right? So again, I will use the restaurant example. Providing a nice service is not the key performance obligation. You are there for food, not for their service. Service is an implied service, is a valid expectation from the customer point of view, right? So therefore, a nice behavior by a restaurant employee is not a performance obligation. The key performance obligation is the food. Once the food is delivered and you pay to the restaurant, only then they can recognize the revenue. Merely providing a nice service will not help them recognize the revenue. Will not help restaurant to recognize the revenue. Let's look at paragraph 26, which basically gives you an example of distinct goods or services. So depending on the contract, promised goods or services may include but are not limited to the following: sale of goods produced by an entity. This is a simple example which you will see in day-to-day life. Resale of goods purchased by an entity, again, a very simple example, right? So entity buys products from someone and then resells it to someone else, right? So that's again providing a distinct good or service. Resale of rights to goods or services purchased by an entity, for example, a ticket resold by an entity acting as a principal, as described in paragraph B4 to B38. So that is, again, B and C are similar, but relatively different in nature, because C is talking about principal agent, right? So a principal could be someone hiring an agent on whose behalf the sales are being happening. Now, option D says, paragraph D says, 26D says, performing a contractually agreed upon task or tasks for a customer, right? So for example, audit services, right? So that is actually a contractually agreed upon task between the audit firm and the client. Then paragraph E, providing a service of standing ready to provide goods or services. For example, unspecified updates to software that are provided on a when and if available basis, or of making goods or services available for a customer to use as and when the customer decides, right? So again, it's providing a service of standing ready to provide goods or services. So these are basically some examples from A to G, as you can see. Actually, A to J, these are all different types of examples of distinct goods and services. So you can read them on your own as well. Let's move on to paragraph 27, which I think are more important in understanding what are the criteria for distinct to help identify if the good or service is actually distinct, because a performance obligation has to be distinct. That is one of the key criteria, as we have seen in paragraph 22 and 23. It has to be distinct to be a performance obligation, in other words. So paragraph 27 says a good or service that is promised to a customer is distinct if both of the following criteria are met, right? So both of the criteria have to be met, 27A, 27B. Both of them have to be met in order for the promise of good or service to be distinct. Right, paragraph 27A says the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. That is, the good or service is capable of being distinct, right? So for example, when you go to an Apple showroom and buy Apple iPhone, right? So that is actually a distinct good because you can take the iPhone, once you have bought it, you can use it, you can sell it, right? You can do whatever you want to do with it, right? So that is actually something distinct, a clear performance obligation when you go to an Apple showroom to buy an iPhone, right? So let's look at 27B. 27B says the entity's promise to transfer good or service to the customer is separately identifiable from other promises in the contract. That is, the promise to transfer the good or service is distinct within the context of the contract, right? So it is separately identifiable within the contract, right? So when you're going to go in an Apple showroom, and then let's say there's a contract that happens between you and the seller, which is the Apple showroom, right? So the contract has to specifically, state, basically, it has to be very clear that you're buying an iPhone, right? So it has to be separately identifiable in that sense. So let's look at paragraph 28, which actually further explains 27A, and then paragraph 29 explains 27B, right? So you will see these key things here. So a customer can benefit from a good or service in accordance with paragraph 27A if the good or service could be used, right? So as I said, consumed, sold for an amount that is greater than the scrap value of otherwise hold. So as I said, right, so once you buy that iPhone, it is very distinct. It is very distinct. You can do whatever you want to do with that iPhone. You can sell it, you can use it, you can give it as a gift to your family members. You can do whatever you want. You can use it for business, right? So this is a very separate thing. So for some goods or service, a customer may be able to benefit from the good or service on its own, right? So that's another thing. For goods or for other goods or services, a customer may be able to benefit from the good or service only in conjunction with other readily available resources. A readily available resource is a good or service that is sold separately by the entity or another entity, or a resource that the customer has already obtained from the entity, including goods and services that the entity will have already transferred to the customer under the contract, right? So again, it's like if you go to an Apple showroom and buy other stuff, right? So there could be other, like, let's say, for example, phone case, right? So that would be another performance obligation on top of buying an Apple iPhone, and the cover is going to protect your phone, right? So now, in this case, what they can do is that this would be a combined one performance obligation. That is, you're buying an iPhone with a cover including, right? So that's what the paragraph is actually talking about. So you can read this paragraph on your own as well to get a better understanding. But the core idea here is basically that the product is very much separate, and the customer who is buying it can actually benefit from the use of the product. So let's look at paragraph paragraph 29, which actually explains 27B in detail. So paragraph 29 says, in assessing whether an entity's promises to transfer goods or services to the customer are separately identifiable in accordance with paragraph 27B, the objective is to determine whether the nature of the promise within the context of the contract is to transfer each of those goods or services individually, or instead to transfer as a combined item or items to which the promised goods or services are inputs, right? Factors that indicate that two or more promises to transfer goods or services to a customer are not separately identifiable include but are not limited to the following. So these are some other examples which basically say that factors that indicate that two or more promises to transfer goods or services to a customer are not separately identifiable. So they include these three options here. So 29A says the entity provides a significant service of integrating the goods or services with other goods or services promised in the contract into a bundle of goods or services that represent the combined output or outputs for which the customer is contracted. So a classic example in this case would be a construction. So let's say you hire a construction company to build your house, right? So in this case, it would be the final product, which is house, that is the performance obligation. Anything that happens in between, let's say they create one room, they have created one room, right? So that creating that one room does not satisfy the performance obligation of the construction company. So in this case, that room is not separately identifiable or any sort of distinct product in itself. Once the house is completed, only then it would be considered as completed performance obligation, and a house full of rooms, which is basically different. There are different inputs. So each individual room would be considered as different input, and then a combined house would be an output in this case, right? And that will basically be your performance obligation. The completed house would be a performance obligation. And so paragraph B says one or more of the goods or services significantly modify. So this is talking about modification in the contract. So once there is a modification in the contract, until and unless they agree on those modifications, it is not going to be separately identifiable. That's the key thing here, not separately identifiable. So contract modifications, until and unless they are approved by both parties, will not be considered as a separately identifiable performance obligation. And then any goods or services which are highly interdependent or interrelated in a sense. In other words, each of the goods or services is significantly affected by one or more of the other goods or services in the contract. For example, in some cases, two or more goods or services are significantly affected by each other because the entity would not be able to fulfill its promise by transferring each of them independently, right? So products which rely heavily on each other as a combined output, that those products, those services of which will not be considered as separately identifiable, and therefore they may not be even considered as distinct because you cannot really separately identify them. So paragraph 30 basically says, if a promised good or service is not distinct, an entity shall combine that good or service with the other promised goods or service until it identifies a bundle of goods or services that is distinct, right? So this is very key thing when you're identifying the performance obligation, that it has to be distinct, and the criteria for distinct is actually stated in 27A and 27B, which is explained in detail in paragraph 28 and paragraph 29. So again, if you look at what is considered as distinct, something which would be considered as distinct is the product itself is very much distinct, and the benefits of the product could be used. The benefits of the product could be used by the customer once he or she has obtained the product, and it should be separately identifiable in terms of the contract itself as well, within the contract as well, right? So that's what it says. Until and unless there is no element of distinct, there is really no performance obligation. It has to be distinct in order to have a performance obligation. Even if you look at paragraph 22, if we go back to paragraph 22, it says that it explains there's a performance obligation when there's a promise of transfer, which is a good or service which is distinct, or a series of good or service which is again distinct, basically. Right, so it says here a series of distinct goods or services. So distinct is a very key word here. So when you are solving these type of questions in your exam, you have to actually assess whether the performance obligation is in itself distinct under the criteria of 27A and 27B. So yeah, you will have to do a lot of practice in that case. Actually, it's not an easy topic, I would say. So let's look at paragraph 31, which is satisfaction of performance obligation. So paragraph 31 says an entity shall recognize revenue when or as, right? So there would be 2 points in time. It's either revenue is recognized over time or at a point in time. So that is what it is trying to highlight in this case here. So an entity shall recognize revenue when or as the entity satisfies a performance obligation by transferring a promised good or service that is an asset to a customer, and an asset is transferred when or as the customer obtains control of that asset, right? So if you want the classic definition of what is an asset, you can actually refer to HKS 16, and I already have a video on that, and exactly that's what they are referring it to here as well. So an asset is when the transfer of that asset when the customer has obtained control over that asset is an asset actually. Is one condition of an asset. So we'll see how accounting standards are actually very, very interrelated at times as well. So let's look at paragraph 32. For each performance obligation identified in accordance with paragraph 22 and 30, right, which we have seen before. So paragraph 22 until 30 actually tells you how to identify a performance obligation. And to summarize again, what is a performance obligation? It's nothing but a transfer of distinct goods or services, or a series of distinct goods or services to the customer. There is a promise of that, and then each these, and how to identify if it's distinct or not, they have to be separately identifiable, and the control is actually transferred. There's an independent product, is a separate product which is transferred to the customer, and the customer can take advantage of once the product is given to the customer can actually direct the control of that good or service, basically. So let's continue with paragraph 32. So it says entity shall determine at contract inception. Again, it has to happen at contract inception. So the company has to identify a performance obligation at the time of contract, at the contract inception. So whether it satisfies the performance obligation over time in accordance with paragraph 35 to 37, or satisfies the performance obligation at a point in time, right? So there are two moments here. So either the performance obligation is recognized over time, or it's at a point in time. For over time, the classic example again would be construction, because house is built in stages and not at one point in time. It will happen over time, and there's only one performance obligation, that is the delivery of the house itself, right? So that would be so the company will actually recognize performance obligations over time, plus the revenue would be recognized over time as well in this case. Right, if an entity does not satisfy a performance obligation over time, the default is the performance obligation is satisfied at a point in time. So the guidelines in the standard actually is very much clear that if it's not over time, then it's by default at a point in time. So paragraph 33 says goods and services are assets, even if only momentarily, when they are received and used as in the case of many services. Control of an asset refers to the ability. So they're defining, the standard is defining what is the control of an asset. So control of an asset refers to the ability to direct the use of and obtain substantially all of the remaining benefits from the asset, right? So the customer is directly getting benefit after getting the control of the assets, benefits from the asset, right? So let's say you bought a tractor. Let's say you bought a tractor for your farmland, right? So you can use that tractor. Once you have the ownership of the tractor, now you can use that tractor in whatever way you want, and all the economic benefits of the tractor, all the economic benefits generated from the tractor belong to only you and not to the other party or the seller. So control includes the ability to prevent other entities from directing the use of and obtaining the benefits from an asset, right? The benefits of an asset are the potential. So they have also defined what is considered as benefits in this case. So benefits of an asset is potential cash inflows or savings and outflows, right? So again, it's a cash inflow that can be obtained directly or indirectly in many ways, such as by using the asset. So they've defined either by using the asset, enhancing the value of asset, selling the asset, pledging the asset, holding the asset, right? So you can do whatever you want to do as long as it's within these things, right? So paragraph 33 merely defines what is a control and what would be considered as benefits from the asset, right? So paragraph 34, when evaluating whether a customer obtains control of an asset, an entity shall consider an agreement to repurchase the asset, right? So these are other paragraphs that you can actually check. So let's look at performance obligations satisfied over time, right? So as we saw before, the company either satisfies performance obligation over time or at a point in time. So of course there are criteria and standards. I've explained those criteria. So let's look at the criteria of performance obligations which are satisfied over time. So paragraph 35 explains that. Paragraph 35 says an entity transfers control of a good or service over time and therefore satisfies the performance obligation and recognizes revenue over time if one of the following criteria is met. So not all the criteria that you have seen, unlike in previous paragraphs where all the conditions, all the criteria have to be met in order for something to be considered as correct or of that thing actually. But in this case, any one, so either 35A, 35B, 35C, if any one of the criteria is met, company has to recognize performance obligations over time. So let's look at 35A, which says the customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs, right? So it has to happen simultaneously. So I think Netflix subscription in this case actually fits in very well. You simultaneously receive and consume the benefit once you are on the Netflix trying to watch some sort of a series there, right? Let's look at 35B. The entity's performance creates or enhances an asset. For example, they have given an example, work in progress, right? So work in progress actually meets criteria 35B, and the performance obligation would be satisfied over time. So that the customer controls as the asset is created or enhanced. And then the last one says the entity's performance does not create an asset with an alternative use to the entity, and the entity has no enforceable right to the payment for the completed part the entity has an enforceable right to the payment of the performance completed to the date, right? So I mean, in this case, you can look at like softwares that companies that develop customized softwares for different companies. Because each software is not one size fits all, each software is curated for one specific company. Therefore, the software doesn't really have an alternative use that will actually meet the criteria 35C, and the performance obligation will be satisfied over time. So again, those software customizations, there could be 10 different customizations the software could have, and then they would be identified. They might be identified as 10 separate obligations, 10 separate performance obligations if they meet the criteria that we have studied in paragraph 27 and 27A and 27B, or it could be only one performance obligation based on the case facts, how they have how the contract has been designed, right? So there are many variables, but again, it's possible that it might meet 35C, and it would be actually performance obligations would be satisfied over time. So let's look at paragraph 36. Paragraph 36 says an asset created by an entity's performance does not have an alternative use to an entity if the entity is either restricted contractually from readily directing the asset for another use during the creation or enhancement of that asset, or limited practically from readily directing the asset in its completed state or for another use, right? So there could be contractual obligations. The contract by itself doesn't allow the company to actually have an alternative use of that asset. Actually, there could be contractual clauses right? So that's why I say you will actually have to study the case study in very depth and see which criteria is being met or is not being met. So you have to put in a lot of effort in this case, actually. But the good thing here is the HKICPA exams are actually open book. So you could, as long as you can refer to the criteria and use your professional judgment very much correctly, because the exam is also testing your professional judgment there. So you can identify things more appropriately. You would have to read the conditions more properly and apply it to the case study. It's basically, the exam is about understanding the conditions and then applying those conditions to the case study, rather than just writing same stuff which is in the standards. That's not going to help you pass the exam. Just my personal opinion. So let's look at paragraph 37. Paragraph 37 says, an entity shall consider the terms of the contract as well as any laws that apply to the contract when evaluating whether it has an enforceable right to the payment for performance completed to date in accordance with paragraph 35C, right? So as I said, these software companies developing customized softwares, they could have 10 different performance obligations, and then for each performance obligation, as soon as that's being satisfied, the company might have an enforceable right to actually at least claim payment for the part which is completed, right? So let's say one performance, one customization is done, the software company may demand from the client a payment for just that part only, and not the entire contract itself. All right, so that would be the case in this case. That's what they're trying to explain in here. The right to the payment for performance completed to date does not need to be for a fixed amount. However, at all times throughout the duration of the contract, the entity must be entitled to an amount that at least compensates the entity for performance completed to date if the contract is terminated by the customer or another party for the reason other than the entity's failure to perform as promised, right? So in this case, exactly what I explained earlier, it says that it's not necessary that the company has a fixed amount already set in the contract, but there's a valid expectation and that the customer will pay for the first customization as soon as it is completed, and it should not, and that is just there. So that what actually explains this whole paragraph. The example actually is basically this paragraph. And paragraph B9 to B13 provides guidance for assessing the existence and enforceability of a right to a payment, and whether the entity's right to payment would entitle the entity to be paid for its performance completed to the date, right? So you have to actually look at these paragraphs as well to see if the entity really has the right and enforceability to the payment. So that would be another key thing. So of course, these standards actually refer to other paragraphs here and there for a few bits. So it's not wholly conclusive. You will have to actually refer to these paragraphs to check for whether they really do have the right. If it's stated in the contract, then most likely the company actually has the right over payment for the parts completed. Now let's look at performance obligations which are satisfied at a point in time. So that's paragraph 38. So paragraph 38 says that if a performance obligation is not satisfied over time in accordance with paragraph 35 to 37 that we just saw, an entity satisfies the performance obligation at a point in time, right? So now the performance obligation will be by default will be at a point in time. Now, to determine the point in time at which the customer obtains control of a promised asset and the entity satisfies the performance obligation, the entity shall consider the requirements for control in paragraph 31 to 34 that we have seen earlier, right? So you will have to see whether actually the control has been passed to the customer or not. So for that, you will actually, what you need to see is whether legally there has been a transfer of ownership, whether the customer has the right to direct the use of the asset, and there were different ways to assess whether the customer has the whether the customer has the right to direct the use of the asset, right? So you can actually go back and study those paragraphs again, but they are there, right? So you will actually, in addition, an entity shall consider the indicators of the transfer of control, which include but are not limited to the following. So these are other additional items that one has to consider in addition to paragraph 31 and 34. So let's look at 38A. So 38A basically says 38A basically says the entity has a present right to the payment for the asset. If a customer is presently obligated to pay for an asset, then that may indicate that the customer has obtained the ability to direct the as soon as, right? So this is basically saying that once you have been given the good, by default, I mean, you have to pay for that good or service, right? So that's what the paragraph A basically says. And let's look at paragraph B. The paragraph B is the customer has legal title to the asset. Legal title may indicate which party to the contract has the ability to direct the use and obtain substantially all the remaining benefits from an asset, or to restrict the access of other entities to those benefits, right? So this is basically talking about the legal title. So present right to payment, legal title. Paragraph C talks about transferred physical possession of the asset, right? So you have actually physically transferred the good. It is under customer's possession, and the customer has significant risk and rewards of ownership, right? So that's basically all about it. And then each of the paragraph goes into detail what they actually mean by it, right? So so like, for example, what would be considered as transferred physical possession of the asset? That it would be the customer's physical possession of an asset may indicate that the customer has the ability to direct the use of and obtain substantially all of the remaining benefits from the asset, or to restrict the access to the asset. However, physical possession may not coincide with the control of an asset. For example, in some repurchase agreements, so they have given you some examples as well, where it will not be applicable, right? So they have given you all sorts of examples which you can read, and based on these criteria, you can actually solve your case study questions and understand what is happening with the performance obligations and how to identify performance obligations. So in a nutshell, how to identify performance obligation would be going through with all of these paragraphs, and you can create flowcharts that will help you. Actually, creating flowcharts will definitely help you in my opinion. But in a nutshell, a performance obligation is nothing but a promise to deliver a good or service which is distinct to the customer. Right now, the standard by itself defines you what would be considered a distinct service or a good, and whether the performance obligation will be recognized at a point in time or over time, right? So yeah, definitely, I would definitely suggest you to maybe rewatch this video and also study the contract, the standard on your own as well, and reread these basically, because it takes time to understand these things. One cannot understand it in one go. So you might have to rewatch this video or any other videos per se, and also read these again and again and apply and think about how this would apply to practical situations, because these standards are actually very practical in that sense. Well, I hope this video was helpful to you in understanding step 2 for revenue recognition standard, which is HKFRS 15. And the step 2 is about identifying the performance obligation. And if you think this video was helpful to you, please don't forget to subscribe to my channel and share it with your other friends who are actually studying for your, chartered accountancy exams or CPA exams, or more specifically studying for the QP exam. Actually, these videos could be helpful for them. So please do share them. And it will be a great motivation for me as well. And once again, thank you very much for watching this video. I hope this was helpful to you. Thank you very much.